In this video, I want to talk about stock splits. Now, why would a company split its stock? When they split their stock, what they're doing is they're creating more shares, but the price of the shares go down. So, for example, if you had a stock that was selling for $100 a share and they split 2 for 1, that is, for every 1 share you now have 2 shares, you're not going to have twice as much money, you're just going to have twice as many shares. So you're going to have 2 shares at $50 a share instead of 1 share at $100 a share. Why split the stock? Well, one reason companies like to split the stock is to lower the price. Now, today, as I'm doing this video, BRKA, which is Berkshire Hathaway Class A stock, is currently selling for $172,710 a share. Why is it so high? Well, it's high because the CEO of the company, Warren Buffett, has never split the company's stock. So the price has just continued to go up. What's the problem with this? Well, if you're a small investor, there aren't a whole lot of small investors that can go out and buy a share of Berkshire Hathaway Class A stock. At $172,710, that's an awful lot of money. If over the years he had split it consistently, you might have a stock price now that's maybe $80 or $90 a share. And if it were $80 or $90 a share, there are probably a lot of people who would go out and buy 100 shares of the stock. But at $172,710, not many people can afford to buy the stock. So one reason for splitting the stock is to lower the price. And you want to lower the price and put it in some what the company thinks of as an optimal trading price. Too high a price, small investors can't afford it. Too low a price, it seems like a penny stock, and people stay away from those. So they like to keep the stock in perhaps the, above $20 or $25, and perhaps maybe under $100 a share. Although there are stocks that have gotten, well, this one's $172,000. There's stocks that are $300, $400, $500 a share. But you'll find that most stocks that trade on the New York Stock Exchange or on the NASDAQ trade for $50, $60, $70 a share. And when they get a little too high, the company splits. So how does a split work? Say you have a 2 for 1 split. And the price before the split was equal to $100. Okay. What happens now is you have twice as many shares at $50 a share. So it hasn't changed the value of the firm at all. It's simply the case that you have more shares and they're worth half the amount. One way to think of it is if you took a $20 bill and somebody gave you 2 tens. You'd have 2 pieces of paper, but they wouldn't be worth any more. In fact, in theory, a stock split shouldn't do anything in terms of increasing the value of the firm or the stock price. I mean, sometimes you'll hear people who aren't very well versed in finance say, "Oh, I'm really happy my company's stock split." And the price always goes back up after the split. Well, eventually it'll get back to $100 a share. But if this company did not split the stock, the price of the stock would have gone from 100 to 200. And if you don't believe that, again, look at Berkshire Hathaway. This is not a company where the stock was always trading at 100,000. When Warren Buffett bought the company back in the early 60s, it was trading for about $12 a share. It's just continued to go up because the earnings have grown and the company is doing better, and so the price of the stock continued to go up. If Mr. Buffett had split the stock, he could have kept the price much more affordable, but he's chosen not to do that. Okay. Another thing that companies sometimes do is they do a reverse split. And a reverse split is exactly what you would think. This would be the case where you would split, for example, 1 for 2. So here you would have half the shares at twice the price. Okay, so for example, suppose a stock were selling for $5 a share. After the 1 for 2 reverse split, now you have the shares selling at $10 a share. Why do you do this? For a lot of the same reasons that you do a split here. When the company's stock gets too low, people get nervous. They start thinking of this as a penny stock. They start thinking of this as a company that will be going bankrupt. So by splitting and bringing the price up, and you don't have to do 1 for 2, you could do 1 for 5, you could do 1 for 10. Here you could do 3 for 2, 3 for 1. There are a lot of ways to split. It doesn't have to be 2 for 1 or 1 for 2. You raise the price. You get it back up into that optimal trading range so it looks like a good, sound company. And people who were nervous about buying the stock for $3 a share all of a sudden see it selling for $20 a share, think, okay, this is a solid company, and I think I'm going to buy into the company. But in principle, a split does nothing more than change the number of shares, but it doesn't change the value of the firm. Now, some people have done studies and found that there is some value in a split, in that a company splits its stock, it's sending a message to the market that times are good and that they expect earnings to continue to grow and the price to increase. You might also argue that a split might be good because people who couldn't buy the stock before because it was too expensive now go in and buy the stock at the lower price, and they bid up the price, and that increases the value of the stock. But if you think about who actually makes the biggest transactions, it's not the small guy who goes out and buys 100 shares. It's the big institutional investors. It's the mutual funds. It's the pension funds. And they really don't care whether the stock is selling for 100 a share or 50 a share or 1,000 a share, because they're going to buy several $1,000,000 worth of the stock, so it doesn't make any difference to them whether they're buying 1,000 shares at $1,000 a share or 10,000 shares at $100 a share. Okay, it doesn't make any difference, and since they're the ones that are the big players, it's really unlikely that splitting the stock is going to have much impact on the price of the stock. So when you hear about a stock split, it's really nothing more than changing your $20 bill for 2 10s. That's a 2 for 1 split. Or exchanging it for 4 5s. That's a 4 for 1 split. Or for that matter, you could exchange it for 21s. That would be a 20 for 1 split. Okay? Whether you have 21s in your pocket or a $20 bill, you're not any worse off and you're not any better off. So all that a stock split does is change the number of shares, and you'll find the price falling to keep the value of the firm the same.